Warren Buffett is without doubt the greatest investor of all time. From 1965 through to 2020, his company Berkshire Hathaway compounded money at 20% per year. That is enough to turn an initial $10,000 investment in 1965 into over $280 million today. And one of Warren Buffett's largest and most famous investments throughout that entire investment career was in this, Coca-Cola, and that is going to be the focus of this video. Now, Coca-Cola was a massively successful investment for Warren Buffett and Berkshire Hathaway, and we'll get into a lot of the details with that particular investment throughout this video. But the other thing that the Coca-Cola investment symbolizes for Warren Buffett and Berkshire Hathaway is that it was really the first time that they had, at a massive scale, put a lot of money into a company that Charlie Munger would describe as a great business at a fair price, as opposed to a fair business at a great price. It was the first time that Warren Buffett had really transitioned away from the Ben Graham, cigar butt style investing into buying high quality businesses that he can own for a long period of time. So in this video, we're going to crack a Coke and we're going to look at the facts for Coca-Cola in 1988. We're going to put ourselves in the shoes of Warren Buffett at that time, look at all of the facts available, and try and decide whether we would have followed Warren Buffett into that investment. We're then going to fast forward 10 years to 1998, and we're going to look back at the decade that really drove a lot of this phenomenal performance for Buffett in that Coca-Cola investment, and look at what sort of return he made out of that entity. Now, Buffett's Coca-Cola investment in 1988 was a $1.3 billion investment. At that time, that was a huge bet for Buffett and Berkshire Hathaway. But to set the scene for that a little bit, we have to go back to 1972 and look at Buffett's purchase of a business by the name of See's Candies. Now, See's Candy is a business that sells box chocolates, and in 1972, Buffett and Berkshire Hathaway acquired See's Candy for a purchase price of $25 million. And like I mentioned earlier, Coca-Cola was really the first time at scale that Buffett had put a lot of money into a great business at a fair price, as opposed to one of these cigar butt Ben Graham style businesses. And a lot of the inspiration for doing that actually came from the purchase of See's Candies. Now, I will put up a screenshot here so that you can see some of the financial performance of See's Candy. And this was really the first time that Warren Buffett had owned one of these wonderful growing companies, and it really showed him the power of buying a high quality franchise business that you can hold and let compound for a long period of time. Now, in 1988, Coca-Cola was not a new, fast-growing business. It says right on this can here that Coca-Cola has been around since 1886. Coca-Cola was very well established, at least in the US. But when Buffett looked at the Coca-Cola investment in the late 1980s, he really identified two key factors that helped him to get over the line with trying to make this investment in Coca-Cola. And after making that investment, Buffett has actually written about these two things extensively, particularly through the 1990s. And those two things, firstly, are the massive international growth prospects that Coca-Cola had at that time. Although they had been around for a very long time in the US by 1988, they still had an enormous runway for long-term growth outside of the US. And the second thing that Coca-Cola had working in their favor was pricing power. And Buffett certainly identified this very early on, and it was really key in him making this investment into Coke. Now, pricing power is simply the idea of being able to push prices up over time, sort of irrespective of what your competitors are doing. And Coca-Cola in this case were able to continue pushing up their prices every single year, and they were able to charge a very meaningful premium over any sort of random store brand cola. And anytime that a business really exercises pricing power, any cent that they add on to the price of that product all goes straight to the bottom line. If Coca-Cola sold a can for $1 or $1.50 or $2, the price to produce that can of Coke wasn't any different. So if they could push that price up over time, it meant that the margins would get better for the business, and the amount of cash that that company would produce would of course grow over time as well. Now, with those two key insights of a long runway for growth and the ability to have pricing power in the marketplace, let's go back to 1988 again and look at some of the financial statements for Coca-Cola and come up with some sort of intrinsic value for that business. Now, we all know that Warren Buffett is searching for companies that he can buy at a significant discount to intrinsic value to give him a margin of safety. Let's go back to 1988 and see whether I, if I were in Warren Buffett's shoes at that time, could come to a similar conclusion and find whether or not Coca-Cola is undervalued. Now, I have to give a big shout out here to the Science of Hitting Investing. The Science of Hitting Investing has been writing articles for several years about Warren Buffett style investing, and I believe is still very active on Twitter. So I'll put links to this specific article that I've used to get a lot of the financial data from the 80s and 90s for Coca-Cola down in the description below. And I'll also put a link to the Science of Hitting Investing's Twitter page as well. So with that said, what I've basically done here is I've firstly gone back and looked at what is happening in the financial statements in terms of both revenue and net income growth for the Coca-Cola company leading up to 1988. And what we see here is that revenue for the Coca-Cola company over the previous 9 years had grown at around 8.8% per year. It had actually sped up in the last 5 years and the last 3 years to where in the last 3 years it had grown at 12.4% compounded. Now, interestingly, net income grew by roughly the same amount, even slightly faster, as again, margins were increasing due to pricing power. And the previous 5 years experienced compounded annual growth of around 13% per year. Now, interestingly, again, the earnings per share for Coca-Cola actually increased even faster. And this was basically a result of share count going down over time, of the Coca-Cola company buying back shares. So if we look at the share count for the Coca-Cola company from 1979 through to 1988, you'll see that the share count goes up for a short period of time through the early 1980s and then comes back down quite a bit in the late 1980s. And for that reason, although the underlying earnings, the net income for the Coca-Cola company was growing at, call it 12% a year over the last 3 to 5 years, the earnings per share were actually growing at closer to 15% per year. Now, the next logical step, of course, is to try and put some of those numbers into a valuation and make some sort of projection about what the company might look like moving forward. And I tried to be as honest with myself as possible and try to do a valuation on what I would do with these numbers back at that time. And basically what I've done here is I have assumed that, you know, Coca-Cola has grown at, call it, the little over 10% mark for, you know, the past decade. I think they've got a continued runway for growth, so I'm going to conservatively estimate that they can grow at 10% a year for the next decade and try and come up with some sort of valuation based on that. Now, if you haven't seen any of my valuation videos before, again, link down in the description below if you want to capture this template as well. And basically what I came up with from those numbers was that I was getting a present value of future cash flows for Coca-Cola at that time of around $23.6 billion. Now, in 1988, Coca-Cola had actually a little bit of cash on hand, well in excess of the debt that they had at the time. So that gave me an intrinsic value for the overall business of about $24 billion. Now, in 1988, the market cap of Coca-Cola was sitting at about $16.3 billion, which, based off my assessment of intrinsic value at the time, gives me about a 32% margin of safety. So, by my calculations at that time, Coca-Cola, if it could continue to execute and grow at around 10% per year, was trading at a pretty good margin of safety, about 30%, not the big 50% I'm often really looking for, but certainly enough to get very interested. Now, one of the advantages, of course, of doing this type of exercise is I can actually jump forward 10 years. I can jump forward from 1988 to 1998 and have a look at what the Coca-Cola company actually did. Did it hit this 10% growth rate, and was I therefore right on my intrinsic value calculation, or did it do better, or did it do worse? Let's have a look and check out what the actual performance of the business was. Now, it turned out that the business actually performed quite a bit better than that 10% per year growth. So if you happen to have a time machine and could jump from 1988 to 1998, like I have done, and you could put those figures for earnings into your discounted cash flow, then this is actually what you get. So rather than doing 10% a year growth, the business actually did 15.8% per year growth for the 5 years following 1988. For the 5 years after that, so getting them right through to 1998 now, it actually sped up in growth and did closer to 20% per year. Now, how does that impact our intrinsic value calculation? Well, if you were able to actually figure that out and, have an opinion that Coca-Cola would in fact speed up in growth rate rather than slow down over this particular decade, then you would have been able to estimate that Coca-Cola was now actually at a 59% margin of safety back in 1988. So all of a sudden we're buying $1 for 40 cents and we're getting a great business in doing that. And in my opinion, this I think is to a large extent what Warren Buffett was betting on. He was able to get a business that if it continued at say 10% a year growth, he was still getting a really good deal around a 30% margin of safety if his hurdle rate was about 10% returns per year. But if he was right with those couple of key insights we talked about earlier and Coca-Cola could in fact grow a little faster than it had in the past, then all of a sudden we're looking at a much more significant margin of safety. Now I do actually have one more valuation to include in this video, and this was basically if you still had that time machine that allowed you to see what the 1988 through to 1998 earnings were, but you could also see what the PE ratio or the free cash flow multiple that investors were willing to buy and sell shares for of Coca-Cola was in 1998. One of the things that happened from 1988 through to 1998 was that the PE ratio of Coca-Cola basically skyrocketed. It ended up trading at its peak in 1998 at around 50 times earnings, about a PE of 50. So not only did you get the really strong growth of the business, but you also got some multiple expansion included in your return as well. And let's just say hypothetically that you knew Coca-Cola was going to get to 50 times earnings in 1998, and you also knew that it was going to grow really, really fast, then you would have been able to calculate that you were probably getting about an 84-85% margin of safety back in the late 1980s. Now, of course, massive multiple expansion is not something we typically want to bet on as investors, but nonetheless, I find it really interesting to note how big a difference that does make in the final returns that you can get as an investor. Now, from 1988 through to 1998, let's have one final look at the actual returns that were generated by Warren Buffett through that time period, because they are rather spectacular. Now, I'll put up a screenshot here of an extract from a Berkshire Hathaway annual report, and this actually tells us the cost basis that Buffett had on this investment, and that was $1.299 billion. Now, if we fast forward to 1998, that 1.3, call it, billion dollars had turned into a market value of $16.8 billion. But that wasn't all that had happened in this particular investment. Every year, Coca-Cola was also paying dividends. And over that 10-year period, he had received about $740 million in dividend. So over that 10-year period, he invests his $1.3 billion up front. He gets about $750 million roughly back over that 10-year period, probably about 2/3 of his money he gets back. And he also has a shareholding that is worth in the market about $16.8 billion. Absolutely massive returns. Now, if we put that into some sort of compounded annual return, basically that comes out at a 32.9% compounded annual growth rate, excluding dividends. He also got, on average, about a 1.5% dividend yield as the price was going up, which comes to a 34.4% annual return, including absolutely everything throughout that 10-year period for the investment. And just for the dividend investors in the audience, I've put together some final stats here around the dividend yield, both the simple dividend yield for each year, so if you were to go out and buy Coca-Cola shares in that particular year, what sort of return you'd be getting from a dividend, as well as something called yield on cost, which basically says as a percentage of the amount of money you invested on day one, how much of that are you getting back through dividends each and every year. So from 1989 all the way through to 1998, Buffett received as low as about a 0.7% dividend yield in 1998, through to as high as about a 2.6% dividend in 1989, not long after he first made that investment. But the interesting thing is that that yield stays kind of in around 1 and 2%. Simply because the share price is going up basically as fast as the dividend is going up. So if we look at the yield on cost, by 1998, that had actually gotten up over 9%. So he was getting about 9% of his money back every single year through dividends compared to, what he initially put in up front. And Warren Buffett today in 2021 still owns these shares. So his actual yield on cost over the past 4 quarters, prior to filming this video, was $1.64 per share, which is about a 51% yield on cost. So back in 1988, he put in $1.3 billion. He's getting about half of that, roughly $650 million back every single year in dividend payments. Now that is the highly successful side of the story of the Coca-Cola investment for Warren Buffett from 1988 through to 1998, and I'm going to actually end the video there. Now, if you're wanting to see the slightly less successful side of this story from 1998 through to 2021, where Coca-Cola did not perform anywhere near as well, let me know down in the comments below. I am more than happy to make a video on that topic and my thoughts on the whole thing as well. But nonetheless, this remains one of Buffett's most famous and well-known investments ever, and I really enjoyed digging into this particular story. So I do hope you enjoyed the video, but that is it from me for this one. If you did, please hit like and hit subscribe as well. Otherwise, I will see you in the next one. Cheers.